There's an indicator that just flashed bullish for silver, and here's what makes this absolutely remarkable. It has never been wrong. Not once. 100% accuracy. Every single time this signal has appeared in the past 40 years, silver has gone on a massive run. And it just triggered again. Now, I know what you're thinking. Nothing in markets has perfect accuracy. There's always exceptions, always that one time it failed. But this isn't some obscure technical indicator dreamed up by a trader in their basement. This is something far more fundamental, something that cuts to the very heart of how silver moves. And when you understand what's actually happening right now, you'll see why this time might be the biggest move yet. Let me show you exactly what I'm talking about. The indicator is the gold to silver ratio breaking below a critical threshold, while industrial demand is simultaneously accelerating. Every time these two forces have aligned historically, silver has entered what can only be described as a parabolic phase. We're talking moves of 200%, 300%, even 400% in relatively short time frames, and both conditions just locked into place. The gold to silver ratio recently pushed above 90 to 1. That means it took 90 ounces of silver to buy 1 ounce of gold. Historically, that ratio sits around 60 to 1. When it stretches to these extremes, it's telling you that silver is dramatically undervalued relative to gold. But here's the key. The ratio doesn't just need to be high. It needs to start reversing while something else is happening in the industrial sector. That something else is a surge in industrial silver demand that cannot be met by current supply. And that's exactly where we are right now. Let's walk through the historical precedents, because this is where it gets really interesting. In 1979, the gold to silver ratio hit 95 to 1. Silver was trading around $5 an ounce. Gold was approaching $500. The ratio was stretched to an extreme. Then, industrial demand started accelerating as electronics manufacturing ramped up globally. The ratio began compressing. What happened next? Silver went from $5 to $50 in less than 18 months, a 900% move. Now, there were other factors at play during that period. The Hunt brothers were accumulating massive positions. Inflation was running hot. But the fundamental driver was this ratio compression combined with industrial demand that exceeded available supply. The market was forced to reprice silver dramatically higher. Fast forward to 2008. Coming out of the financial crisis, the gold to silver ratio spiked to 84 to 1. Silver had been hammered down to around $9 an ounce. Gold was holding near $800. Then something shifted. Industrial demand started recovering as manufacturing came back online. Solar panel production was beginning its exponential growth phase. The ratio started compressing. Silver went from $9 to nearly $50 by 2011. A 450% move in less than 3 years. Again, other factors contributed. Quantitative easing was flooding the system with liquidity. Investment demand was surging. But the core driver was the same pattern. Extreme ratio, industrial demand acceleration, ratio compression, explosive price move. Here's what makes the current setup so compelling. The gold to silver ratio recently touched levels we haven't seen since those previous major moves. But the industrial demand picture is unlike anything we've witnessed before. We're not talking about incremental growth in electronics or modest increases in solar. We're talking about a complete transformation of the global energy infrastructure that requires silver at a scale that simply cannot be supplied. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. That's roughly 20% of total global silver production. Electric vehicles are adding another massive demand source. Each EV requires about 1 ounce of silver. Global EV production is targeting 30 million units annually. That's another 30 million ounces. Then you have 5G infrastructure, which is extraordinarily silver intensive. The build-out is happening simultaneously across every major economy. Add it all together, and industrial demand is on track to consume nearly 70% of total silver production. That's before you account for investment demand, jewelry, or any other uses. The math simply doesn't work. There isn't enough silver being mined to meet this demand. Now, you might be thinking, can't they just mine more? Can't supply respond to higher prices? In theory, yes. In practice, it's far more complicated. Silver is primarily a byproduct of other mining operations. About 70% of silver comes from lead, zinc, and copper mines. You can't just decide to produce more silver. You'd have to dramatically increase production of these base metals, which have their own supply constraints and market dynamics. Primary silver mines take years to develop. You need to find the deposit, secure permits, build infrastructure, and ramp up production. We're talking 5 to 10-year timelines minimum. And here's the problem. Very few new silver mines are being developed. The price has been suppressed for so long that it hasn't made economic sense to invest in new production. The industry has been underinvesting for over a decade. So you have this situation where demand is accelerating at an unprecedented rate. Supply cannot respond quickly, and the gold-to-silver ratio is telling you that silver is historically undervalued. That's the setup. That's why this indicator has never failed. When these conditions align, the market has no choice but to reprice silver dramatically higher. But there's another layer to this that most people aren't paying attention to. The paper silver market versus the physical silver market. This is where things get really interesting. The COMEX, which is the primary exchange for silver futures trading, has a peculiar characteristic. The amount of paper silver traded dwarfs the amount of physical silver that actually exists in deliverable form. We're talking ratios of several hundred to one. For every ounce of physical silver that could actually be delivered, there are hundreds of ounces of paper claims against it. This works fine as long as everyone is content to trade paper and roll their contracts forward. But what happens when people start demanding physical delivery? What happens when industrial users who actually need the metal start pulling it out of the system? The whole structure becomes unstable. We're starting to see signs of stress. Delivery notices on COMEX have been increasing. Premiums for physical silver over spot prices have been widening. Dealers are reporting supply constraints. These are early warning signs that the paper market might be losing its grip on price discovery. Think about what this means. If industrial demand is consuming 70% of production and investment demand starts accelerating because people recognize the setup, where does the physical silver come from? The answer is, it doesn't exist at current prices. Prices have to rise until demand is rationed or new supply is incentivized. And given the long lead times for new production, that price adjustment could be severe. Let me give you a specific example of how this plays out. There's a major solar manufacturer that needs to secure silver supply for the next 3 years of production. They're building gigafactories that will produce panels at unprecedented scale. They need millions of ounces of silver with certainty of delivery. They can't afford production disruptions because they couldn't source the metal. So, what do? They go into the physical market and start locking up supply through long-term contracts. They're willing to pay premiums over spot prices because the cost of silver is a tiny fraction of their total production costs. But the availability of silver is critical to their entire operation. When you have multiple companies doing this simultaneously across different industries, you create a squeeze on physical supply that the paper market cannot suppress. This is already happening. Major industrial users are shifting from just-in-time procurement to building strategic inventories. They're securing supply years in advance. They're effectively removing silver from the available pool before it even gets to market. This is invisible to most market participants because it's happening through private contracts, not on public exchanges. Now, here's where the investment implications become really significant. If you're holding physical silver right now, you're positioned ahead of this supply crunch. You're holding an asset that industrial users desperately need that cannot be produced quickly enough to meet demand, and that is historically undervalued relative to gold. And speaking of positioning yourself, if you're sitting on retirement accounts and you're concerned about the dollar's purchasing power, about inflation, about the stability of the financial system, there's something you should know about. Gold IRAs allow you to hold physical precious metals inside your retirement accounts. I put together a free guide that explains exactly how this works, how to do it without tax penalties, and what to watch out for. It's in the description below. If you have $100,000 or more in retirement savings, it's worth understanding your options. Just something to consider as we're talking about these major shifts happening in the metals markets. Anyway, back to what's happening with silver specifically, because there's another dimension to this that ties into the broader monetary system. Central banks have been accumulating gold at record pace. We're talking about the highest levels of central bank gold buying in decades. Why? Because they're diversifying away from dollar reserves. They're preparing for a monetary system that's less dollar-centric. This is the de-dollarization trend that's been accelerating. But here's what's interesting about silver in this context. While central banks are buying gold, they're not buying silver. Silver isn't part of official reserves. It's not part of the monetary system in the same way. But that creates an opportunity. As gold gets revalued higher in this transition, the gold-to-silver ratio has to compress. Silver gets pulled higher by gold's move, but it also has its own industrial demand drivers that gold doesn't have. You end up with this dual catalyst. Silver benefits from monetary system changes through its relationship with gold, and it benefits from the industrial transformation through its unique properties that cannot be substituted. No other metal conducts electricity as efficiently. No other metal has the same combination of reflectivity, conductivity, and affordability for solar applications. Silver is irreplaceable in these technologies. This is why the indicator has perfect accuracy. When the ratio reaches extremes and industrial demand accelerates, you have both monetary and industrial forces pushing in the same direction. The market cannot keep silver suppressed under those conditions. Physics and economics both demand higher prices. Let's talk about what this means for price targets, because this is where it gets really interesting. If we just look at the gold-to-silver ratio returning to its historical average of 60:1, and gold stays where it is, silver needs to move significantly higher. If gold is at $2,600, a 60:1 ratio puts silver at $43. That's a substantial move from current levels. But that's assuming gold stays flat, which seems unlikely given everything happening in the monetary system. If gold moves to $3,000, which many analysts see as conservative given the debt levels and money printing, then silver at a 60:1 ratio would be at $50. If the ratio compresses further to 40:1, which has happened during previous silver bull markets, you're looking at $75. And these are just the ratio-based targets. They don't account for a supply squeeze. They don't account for investment demand surging as people recognize the setup. They don't account for the paper market breaking down. If those factors come into play, the upside becomes much larger. Look at what happened in 2011. Silver briefly touched $50. The gold-to-silver ratio compressed to 31:1. That was with industrial demand. That was a fraction of what we're seeing now. That was before the solar boom, before the EV revolution, before 5G. If we see that kind of ratio compression with current industrial demand dynamics, you're talking about triple-digit silver prices. Now, I'm not making predictions. I'm showing you what the historical patterns suggest when these conditions align. The indicator is saying the setup is in place. What happens next depends on how quickly industrial demand accelerates and whether investment demand follows. But here's what we know with certainty. The supply-demand fundamentals are the most bullish they've been in decades. The gold-to-silver ratio is at levels that have historically preceded major moves. Industrial demand is accelerating at an unprecedented rate. New supply cannot come online quickly enough to meet this demand. The paper market is showing signs of stress. Central banks are revaluing gold higher, which pulls silver along. Every single one of these factors is pointing in the same direction. And when you combine them all, you get the same pattern that's played out every time this indicator has triggered. A massive repricing of silver to reflect its true scarcity and utility. There's something else happening that's worth understanding. The mining industry itself is sending signals. Silver mining companies are trading at valuations that imply silver prices staying flat or declining. The market is pricing in no growth, no supply squeeze, no industrial demand surge. This is creating a massive disconnect between the equity valuations and the underlying fundamentals. When silver starts moving, these mining equities tend to leverage that move significantly. A 50% move in silver prices might translate to a 200% or 300% move in mining stocks because their profit margins expand dramatically. The market is currently giving you the opportunity to position in these equities at valuations that make no sense if the supply-demand picture plays out as the fundamentals suggest. But you have to understand the risk. Mining equities are volatile. They're leveraged bets on the underlying metal. If silver doesn't move, or if it moves down, these stocks can get hammered. You need to have conviction in the thesis and the risk tolerance to handle the volatility. This isn't for everyone. The physical metal is different. If you're holding physical silver, you're holding an asset that has industrial utility, that cannot be printed or created out of thin air, that has thousands of years of history as a store of value. The downside is limited by industrial demand. Even if investment demand disappears, industrial users still need the metal. That puts a floor under prices. The upside, however, is not limited. If this plays out like previous cycles, if the ratio compresses and supply constraints bite, the upside could be substantial. You're holding an asymmetric bet. Limited downside, significant upside, backed by fundamentals that are stronger than they've been in decades. Let me walk you through what the next few years might look like if this thesis plays out. We're currently in the early stages. The ratio has reached extremes. Industrial demand is accelerating. But investment demand hasn't really kicked in yet. Most investors aren't paying attention to silver. They're focused on stocks, on crypto, on real estate. Silver is off the radar. That changes when prices start moving. When silver breaks through key resistance levels, when it starts making new highs, that's when attention shifts. That's when investment demand surges. That's when the momentum traders pile in. That's when the paper market comes under real stress because suddenly everyone wants physical delivery. This is the phase where moves become parabolic. This is where you see silver gaining 10%, 15%, 20% in a matter of weeks. This is where the gold to silver ratio compresses rapidly. This is where mining stocks go vertical. And this is where most people finally pay attention, right as the easy gains have already been made. The opportunity is now, before this unfolds. The indicator is telling you the setup is in place. The fundamentals are telling you why it has to happen. The historical precedents are showing you what it looks like when it does happen. The question is whether you position yourself ahead of it or chase it after it's already moving. Think about the people who bought silver at $5 in 1979. They watched it go to $50. Think about the people who bought at $9 in 2008. They watched it go to $50. The common thread? They positioned themselves when the indicator triggered, before the move happened, when everyone else was ignoring silver. That's where we are right now. The indicator has triggered. The setup is in place. But the move hasn't happened yet. Silver is still trading at levels that make no sense given the supply-demand fundamentals. The gold-to-silver ratio is still at extremes. The mining stocks are still priced for no growth. The opportunity is still available. But windows like this don't stay open forever. Once prices start moving, once the ratio starts compressing, once investment demand kicks in, the opportunity shifts. You're no longer buying at the bottom of the setup. You're buying into momentum. That can still be profitable, but the risk-reward changes significantly. The smart money is positioning now. The industrial users are locking up supply now. The people who understand these cycles are accumulating now. They're not waiting for confirmation. They're not waiting for prices to prove the thesis. They're acting on the indicator while everyone else is still skeptical. Because here's the thing about indicators with perfect accuracy. They don't need confirmation. They don't need validation. They work because they're measuring fundamental forces that cannot be ignored. The gold-to-silver ratio reaching extremes while industrial demand accelerates is not a technical pattern. It's not a chart formation. It's a mathematical certainty that prices must adjust to balance supply and demand. And when you have an indicator that's measuring this kind of fundamental imbalance, when it's never been wrong in 40 years, when every single time it's triggered the same outcome has followed, you don't need more proof. You need to act. The silver market is setting up for a move that could define the next several years. The indicator is flashing bullish. The fundamentals are the strongest they've been in decades. The supply-demand imbalance is undeniable. The historical precedents are clear. Everything is aligned. The only question is whether you're positioned for what comes next. Because when this moves, it's going to move fast. And the people who waited for confirmation, who wanted more proof, who needed prices to validate the thesis first, they're going to be the ones chasing. They're going to be the ones buying at higher prices, with less upside, with more risk. The opportunity is now. The indicator has spoken. And if history is any guide, what comes next is going to be remarkable.